Have you ever felt like you're just drowning in information? Especially, with really technical stuff like financial regulation. Trying to figure out what really matters? What the
I
actual impact is? Yeah, it can feel almost impossible sometimes. Well, welcome to the deep dive. Think of this as your shortcut, hoping you get properly informed. We cut through the jargon, pull out the key insights, the surprising bits, and hopefully have a bit of fun doing it. Today, we're taking a deep dive into FRS 103 insurance contracts. Our mission: to unpack the accounting and reporting rules for companies in the UK and the Republic of Ireland that issue insurance contracts. And why should you care? Well, these standards are crucial for transparency, for consistency, and frankly, for trust in the insurance sector. And that's a sector that, let's face it, touches pretty much everyone's life in some way. So we're going to pull out the core ideas and what they mean in practice. No fluff. Right, let's get started. Our main source today is the official FRS 103 Insurance Contracts document, published September 2024 by the Financial Reporting Council. Before we jump into the standard itself, maybe you could tell us a bit about the FRC. What's their main job here?
Absolutely. The SRC, the Financial Reporting Council, their main role is really serving the public interest. Think of them as setting the standards for good corporate governance, for reporting, and for audit quality here in the UK. FRS 103 is one of their accounting standards, and it applies in both the UK and the Republic of Ireland. Their big picture goal, the thing that drives everything, is making sure that users of accounts, so people like you, get financial information that's high quality, understandable, and importantly, proportionate. It should match the company's size and complexity and what users actually need to know. It's all about building trust through clear reporting.
Okay, that makes sense. They set the rules for clarity and trust. So who exactly has to follow this specific standard, FRS 103? Is it just the huge insurance companies?
No, it's actually broader than you might think. Basically, any company that applies FRS 102.
Which is the main UK and Ireland accounting standard, right?
Yeah, exactly. If you're using FRS 102, you also have to apply FRS 103 for any insurance contracts you issue or hold, and that includes reinsurance contracts, and even some other financial instruments if they have something called a discretionary participation feature. So yeah, it catches quite a few entities.
Right, so we know who sets the rules and who follows them. Let's get into the nitty-gritty. What exactly is an insurance contract, according to FRS 103?
It sounds obvious, maybe, but I suspect there are some important details hidden in the definition.
You're absolutely right. It seems simple, but the definition is precise and really important. At its core, an insurance contract is one where the insurer accepts significant insurance risk from the policyholder. That means they agree to compensate the policyholder if a specified uncertain future event negatively affects them.
Okay, uncertain future event. Tell me more about that part. Well, the uncertainty can take different forms. It might be uncertainty about if the event will happen at all, or when it will happen, or even how much the insurer will have to pay out if it does occur. A classic example is life insurance. Death is certain, eventually, but the timing isn't, you see. That uncertainty is key. Or think about reinsurance covering claims that have already happened, but where the final cost isn't known yet. That's also covered. And sometimes the compensation isn't even cash. The contract might allow the insurer to, say, replace a stolen item directly.
Okay, this is where I think it gets really interesting. How do you separate insurance risk from just plain financial risk? That seems like a critical distinction for accounting.
It's fundamental. The standard is very clear. Insurance risk is specifically defined as risk other than financial risk. Financial risk is tied to market variables. Think interest rates, commodity prices, maybe credit ratings, things like that. General market movements.
Right.
Insurance risk, on the other hand, is risk transferred from the policyholder to the insurer that isn't financial risk. So the risk of your specific warehouse burning down, that's insurance risk. It affects you directly and specifically. But say a contract whose payout depends only on a general index of hurricane wind speeds in a region or average temperatures. If it's not linked to a specific party suffering a direct loss because of those things, it's likely just financial risk.
Yeah.
And the standard is also clear that certain other business risks for the insurer, like policyholders lapsing their contracts or admin costs being higher than expected, those are not insurance risks.
So, putting this into practice, could you give us some concrete examples? What sort of things are definitely insurance contracts under FRS 103 and maybe some surprises about what isn't?
Sure. Obvious ones first. Theft insurance, life insurance, annuities, disability cover all clearly in. Product warranties can be interesting. If they're issued by a third party, not the manufacturer or retailer selling the product, they often count as insurance contracts. Even things like fixed-fee car breakdown assistance can be an insurance contract because the service depends on an uncertain event, the breakdown. Catastrophe bonds often fit too, where payments are linked to a specific damaging event, unless the trigger is purely financial, like just an interest rate change.
And what's typically not an insurance contract then?
Well, investment contracts where there's no significant insurance risk, maybe a life policy with a tiny death benefit compared to the investment element. Self-insurance is out because you haven't transferred the risk to someone
Right, you're
else.
just setting money aside yourself.
Exactly. Gambling contracts don't count either because they don't require the policyholder to be adversely affected. And pure derivatives that only expose parties to financial risk, those fall under other standards. If it's not an insurance contract by this definition, it gets accounted for differently under FRS 102, often using what's called deposit accounting or maybe revenue recognition rules. And one really crucial point: whether the insurance risk is significant is judged contract by contract. It's not about whether it's material to the insurer's overall business.
That contract by contract point seems really important. Okay, so once you've decided something is an insurance contract, how does the accounting work? Is FRS 103 very prescriptive, or is there some flexibility?
This is actually one of the most striking things about FRS 103. It largely permits insurers to stick with their existing accounting policies for insurance contracts.
Really? So they didn't have to completely change everything when it came in?
Not necessarily, no. It was a deliberate choice to provide some stability, especially given all the other regulatory changes happening around the same time, like Solvency II. It allows for continuity, which is pretty significant.
But can they change policies if they want to, maybe to align better with new regulations?
Yes, they can change policies, but there's a strict condition. The change has to make the financial statements either more relevant and no less reliable, or more reliable and no less relevant. You can't just change for any reason. And a key driver for acceptable change is often aligning policies more closely with the technical provision rules in the PRA rulebook. That's the UK implementation of the big European Solvency II directive on capital requirements.
Okay, so you can change for good reasons, but what about just being more conservative? Can an insurer decide to, build in extra buffers just to be safe, sort of pad the books a bit?
The standard anticipates that. It talks about excessive prudence. If an insurer already had practices that were excessively prudent when the standard came in, they could continue them. But, and this is important, they are prohibited from introducing additional prudence if their existing measures are already considered sufficiently prudent. You can't just add extra layers of caution arbitrarily.
Interesting. So it tries to prevent overly conservative accounting.
Exactly. There's also something called shadow accounting, which is permitted but not mandatory. This allows unrealized gains or losses on assets backing insurance liabilities to be reflected in how those liabilities are measured, kind of mirroring how realized gains and losses affect them. It helps reduce mismatches.
So there's some flexibility, but with clearer boundaries.
Yeah.
What about the absolute must-dos? What are the non-negotiable requirements in FRS 103?
Right. Even with the flexibility, there are some hard rules. First, the liability adequacy test, or LAP. Every reporting period, insurers must check if their recognized insurance liabilities are enough to cover future cash flows using up-to-date estimates. If there's a shortfall, a deficiency, it has to be recognized in profit or loss immediately. No hiding it.
Okay, that makes sense. Check you've got enough put aside. What else?
Second, you generally can't recognize provisions for possible future claims on contracts that don't even exist yet. Think catastrophe provisions for future storms. Unless the specific regulatory framework absolutely requires it, you can't provide for claims on policies you haven't even written. Third, there are strict rules against offsetting. You can't net off reinsurance assets against the insurance liabilities they relate to, or offset the related income and expenses. They have to be shown separately.
Keep things distinct.
Yes. And finally, insurers must assess their reinsurance assets for impairment. If there's objective evidence they might not collect all the money they're owed from their reinsurer, they need to recognize that potential loss.
Okay, got it. Now, you mentioned the insurance world is vast. FRS 103 has specific sections for long-term insurance business. What's special about that?
That's right. Sections 3 and 5 deal specifically with long-term business, which is mainly things like life assurance. These sections also served as a kind of benchmark for setting accounting policies back when the standard started on January 1st, 2015. It provided a baseline.
So what are the key things in those sections?
Well, things like how you recognize premiums usually when they're due for payment, and claims recognition when they're due or when the insurer is notified, like for a death claim. There are rules around deferring acquisition costs, the costs of getting new business. Generally, you defer and amortize them, but interestingly, not for with-profits funds. Those costs are treated differently.
With-profits funds, they often seem to have special rules. How are their liabilities measured?
They do. For with-profits business, the liabilities to policyholders are measured at their realistic value. This value is then adjusted basically to carve out the shareholder slice of any expected future bonuses. Any changes in this measurement go through profit or loss, but there's a corresponding transfer to or from a special reserve called the Fund for Future Appropriations, the FFA. That's kind of the pot for future policyholder bonuses.
Right. And what about this value of in-force business?
Yes, the VIF. This applies particularly if you're, say, a bank with an insurance subsidiary. FRS 103 allows these groups to continue recognizing an asset representing the expected future profits from their existing life insurance policies, the VIF. But there's a condition. The valuation method used must exclude any future investment margins that belong to shareholders.
Okay, so lots of detail there. With all this complexity, how does FRS 103 make sure the financial statements are actually clear and useful for people reading them? Transparency must be key.
Oh, absolutely. Transparency is a huge focus. FRS 103 requires extensive disclosures, much more than the general requirements in FRS 102. The goal is to make sure users can understand the amounts showing up in the financial statements that come from insurance contracts.
So what kind of things do they have to disclose?
Well, the basics first. The recognized assets, liabilities, income, expenses, and cash flows from insurance contracts. But then it goes deeper. They need to explain the key assumptions they used in their measurements, the ones that have the biggest impact, and provide quantified disclosure of those assumptions where practical. They also need to show reconciliations explaining how insurance liabilities, reinsurance assets, and related deferred acquisition costs have changed during the period.
Yeah, okay, showing the moving parts.
Exactly. And then there's a major focus on risk. Insurers have to disclose detailed information about the nature and extent of risks arising from their insurance contracts. This covers their risk management objectives, policies, processes, how sensitive they are to insurance risk, any concentrations of risk, and a really important one, claims development. They have to show how actual claims are panning out compared to what they estimated in previous years. Often this requires showing data going back maybe 5 or even 10 years.
Wow, that gives real insight into how good their forecasting is.
It certainly does. They also need to disclose information about credit risk, liquidity risk, and market risk, especially if it comes from embedded derivatives that aren't measured at fair value. And the FRC specifically said, no disclosure exemptions for captive insurers. Everyone has to lay out this information clearly.
Right, standards like this don't stand still, do they?
Thanks.
They have to adapt. How has FRS 103 changed since it came in, and what's the direction of travel?
You're right, they definitely evolve. FRS 103 itself became effective back on January 1st, 2015. It pulled together previous guidance, replacing FRS 27 and incorporating bits from the international standard IFRS 4 and industry practice. Since then, there have been several key amendments. In May 2016, updates came through to align with the big Solvency II's regulatory changes. That included allowing new insurers to adopt policies consistent with Solvency II right away. Then in December 2020, there were amendments mainly reflecting changes in UK company law after Brexit. And most recently, as part of the Periodic Review 2024 that was issued in March 2024, there were further changes. Things like adopting the new definition of fair value from IFRS 13 and other knock-on effects from changes to FRS 102. Most of those kick in from January 1st, 2026, although a few transition bits started even earlier this year, Jan 2024. So yes, constantly being tweaked.
That leads to the big question many people might have. What about the global standard? IFRS 17 insurance contracts. It's effective worldwide now. Is FRS 103 going to merge with that?
That is the key question right now, and the answer is, well, no, not yet. IFRS 17 did indeed become effective globally from January 1st, 2023. However, the FRC has made a very deliberate decision not to align FRS 103 with IFRS 17 for the time being.
Why not, if it's a global standard?
They want to wait and see. They want several years of practical experience with IFRS 17 globally before they even consider adopting it or something like it into UK GAAP. But there's a more fundamental reason, too. The FRC has stated very clearly that there are direct conflicts between how IFRS 17 works and the requirements of UK company law.
Conflicts? Like what?
Essentially, the way IFRS 17 measures certain things and recognizes profit over time doesn't easily fit with the presentation formats and some underlying principles required by the Companies Act for UK accounts. You literally can't apply IFRS 17 in full and comply with UK law as it stands. And reinforcing the separation, that March 2024 amendment we mentioned, it added a very specific rule. It says if an insurer used to apply IFRS maybe in group accounts and then transitions to FRS 103 for its individual accounts, it must disregard its previous IFRS accounting policies for insurance. It has to apply FRS 103 as if starting from scratch. They explicitly blocked the route to just bringing IFRS 17 principles across into FRS 103 reporting.
Wow, okay. So a definite divergence there, at least for now. Right, well, that's been a truly comprehensive journey through FRS 103. We've covered its core purpose from the FRC, we've dug into that really nuanced definition of insurance contract, separating insurance from financial risk. We looked at the flexibility in accounting policies, but also those strict non-negotiables, the specific rules for long-term business, and the crucial disclosures needed for transparency.
Indeed. FRS 103 really provides a solid, though, as we've seen, evolving framework for insurance reporting in the UK and Ireland. It struck that balance between allowing some stability and continuity while also adapting to major regulatory shifts like Solvency II and demanding clear, useful information. It highlights just how vital that transparency is in such a critical part of the economy.
So, considering how FRS 103 is deliberately evolving separately from the global IFRS 17 standard, citing those conflicts with company law, it leaves us with a thought for you to ponder. How might this ongoing divergence between UK and Irish accounting standards and the international approach actually impact the comparability of financial reports? And what could that mean down the line for companies, investors, and maybe even customers operating across these different landscapes?